How to build a diversified investment portfolio for long-term success. In today's fast-paced financial world, building a diversified investment portfolio is essential for anyone looking to achieve long-term success. Diversification is a strategy that reduces risk by spreading investments across various asset classes, sectors, and geographical regions. By understanding the fundamentals of diversification and following a structured approach, investors can better manage risk and optimize returns. This video will guide you through the process of building a diversified investment portfolio. Why diversification matters. Before delving into how to build a diversified portfolio, it's crucial to understand why diversification is vital. Risk reduction. The primary benefit of diversification is risk mitigation. By spreading your investments across different assets, you reduce the impact of a poor-performing investment on your overall portfolio. If one investment fails, others may perform well, balancing out potential losses. Smoother returns. Diversification helps achieve more stable returns over time. While individual assets may be volatile, a well-diversified portfolio tends to have less fluctuation in value, making it easier to stay invested during market downturns. Exposure to growth opportunities. A diversified portfolio can provide exposure to various sectors and asset classes, allowing investors to capitalize on growth opportunities in different areas of the economy. Inflation protection. Different asset classes respond differently to inflation. A diversified portfolio can help safeguard your investments against the erosive effects of inflation on purchasing power. Long-term wealth accumulation. By maintaining a diversified approach, investors are more likely to achieve consistent returns over the long term, contributing to overall wealth accumulation. Steps to build a diversified investment portfolio. Step 1. Assess your financial goals. Before diving into asset allocation, it's essential to clarify your financial goals. Ask yourself the following questions. What is my investment horizon? Understanding whether you are investing for the short term or long term will influence your strategy. What level of risk am I comfortable with? Everyone has different risk tolerances based on their financial situation, personality, and investment goals. What are my specific goals? Are you saving for retirement, a house, or your child's education? Your goals will shape your investment strategy. Step 2. Understand different asset classes. To diversify effectively, you need to familiarize yourself with the various asset classes available. Here are the primary asset classes. Stocks. Equities represent ownership in companies and have the potential for high returns. They are categorized into large cap, mid cap, and small cap stocks, as well as growth and value stocks. Bonds. Fixed income investments, like government and corporate bonds, provide regular interest payments and can help stabilize a portfolio. They typically have lower risk compared to stocks. Real estate. Real estate can offer rental income and potential appreciation. Investors can purchase physical properties or invest through real estate investment trusts, REITs. Commodities. These include physical goods like gold, silver, oil, and agricultural products. Commodities can serve as a hedge against inflation and provide diversification. Cash and cash equivalents. This includes savings accounts, money market funds, and treasury bills. These assets are highly liquid and carry low risk, serving as a safety net in volatile markets. Alternative investments. This category encompasses assets like hedge funds, private equity, and cryptocurrencies, which may offer unique growth opportunities but often come with higher risk. Step 3. Determine your asset allocation. Asset allocation refers to how you distribute your investments across various asset classes. The right allocation depends on your financial goals, risk tolerance, and investment horizon. Here are some general guidelines. Risk tolerance. Conservative investors typically prefer a higher allocation to bonds and cash equivalents to minimize risk. 70% bonds, 20% stocks, 10% cash. Moderate investors balance between risk and reward with a mix of stocks and bonds. 60% stocks, 30% bonds, 10% cash. Aggressive investors focus on growth with a higher allocation to stocks Egg, 80% stocks, 15% bonds, 5% cash. Investment horizon. Short-term goals, 1 to 5 years. More conservative allocation with a focus on stability. Egg, 70% bonds, 20% stocks, 10% cash. Medium-term goals, 5 to 10 years. Balanced approach with moderate risk. Egg, 60% stocks, 30% bonds, 10% cash. Long-term goals, 10 plus years. Higher stock allocation for growth potential. Egg, 80% stocks, 15% bonds, 5% cash. Step 4. Select individual investments. Once you have determined your asset allocation, it's time to choose specific investments within each asset class. Stocks. Research individual companies or consider exchange-traded funds, ETFs, and mutual funds that track specific indices or sectors. Look for funds with low expense ratios and strong historical performance. Bonds. Consider a mix of government and corporate bonds. Bond funds can provide diversification across multiple bonds and reduce individual bond risk. Real estate. Decide whether to invest directly in properties or through REITs. If investing in physical properties, consider location, rental potential, and property management options. Commodities. You can invest in commodities directly or through ETFs that track commodity indices. Research market trends to understand commodity price movements. Cash. Keep a portion of your portfolio in liquid assets for emergencies and short-term needs. High-yield savings accounts and money market funds can offer better returns than traditional savings accounts. Step 5. Rebalance your portfolio regularly. Over time, market fluctuations can cause your asset allocation to drift from your original plan. Regularly rebalancing your portfolio is essential to maintain your desired risk level. Here's how to do it. Set a schedule. Consider rebalancing quarterly, semi-annually, or annually based on your preferences. Review performance. Assess which asset classes have performed well and which have underperformed. Realign your investments to meet your target allocation. Adjust for changes. If your financial goals or risk tolerance change, adjust your portfolio accordingly. Step 6. Stay informed and educated. Successful investors continuously educate themselves about market trends, economic indicators, and investment strategies. Here are some tips to stay informed. Follow financial news. Regularly read financial news outlets, subscribe to investment newsletters, and follow credible financial analysts on social media. Join investment groups. Consider joining local or online investment clubs where you can share knowledge and learn from others. Take courses. Invest in your education by taking online courses on investment strategies, financial markets, and personal finance. Consult professionals. If needed, work with a financial advisor who can provide personalized advice based on your goals and risk tolerance. Step 7. Be patient and disciplined. Investing is a long-term endeavor, and it's crucial to remain patient and disciplined throughout the process. Market fluctuations and economic downturns are normal. Avoid making impulsive decisions based on fear or greed. Stick to your investment strategy and trust in the power of diversification. Building a diversified investment portfolio is a fundamental strategy for achieving long-term financial success. By understanding the importance of diversification, assessing your financial goals, and following a structured approach to asset allocation, you can create a balanced portfolio that reduces risk and maximizes returns. Remember to stay informed, regularly rebalance your portfolio, and remain patient throughout your investment journey. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also, subscribe to our channel before you go. Thank you for watching.